So we have evidence now that human activities are dominating Earth system processes. So science is often alluding to this epoch of the Anthropocene, where human actions, human activities are the key drivers of change happening all around us. And this epoch, this Anthropocene era, brings a new global risk landscape where things are interconnected. So risks aren't sectoral. You can't treat risks as just biophysical or economic or social. These things are highly interconnected. And we're going to be seeing an epoch of increasing systemic shocks happening. COVID-19 just being a very recent example of how biophysical, economic, and social things intertwine to lead to massive consequences on the planet. So this is what we'll be exploring in part of this roundtable, especially the first panel discussion. What does this risk landscape in the Anthropocene look like in the ocean? And before I go on with the agenda, I'd just like to invite Karen Sack to also give some opening remarks to you all. Thanks.
Thanks so much, Albert. It's a pleasure to be here. You know, when Albert and I sat down several months ago to start thinking about this, we wanted to look back at kind of the last 50 years and the different world summits and where the ocean has featured. And certainly, I think it's very clear to say that there was very little mention of the ocean between 1972 and 2002. In 2002, at the People's Summit that ran in parallel to the Johannesburg Earth Summit, there was a convening of ocean NGOs and fisherfolk, which flagged some of the critical inequities and the dangers of overfishing, of destructive and industrial fishing and illegal fishing. Interestingly, at the same time, there were calls made then to protect the whole of the Southern Ocean. But primarily that was, the focus was really on industrial overfishing. By the time we got to Rio in 2012, the ocean had become a bigger issue on the international agenda, with calls incorporated on protecting high seas biodiversity. But the connections between impacts of climate change and pollution, particularly from plastics and nutrients, were barely discussed. And that's really the opportunity we have now as we look forward to the Stockholm +50 meeting in 2022 to recognize this multiplicity of challenges, but also the opportunities that are on the table if we act quickly, because the difference between now and 50 years ago is we actually know what the solutions are. We don't really need more gatherings for discussion and elaboration. What we need is action. And you know, that includes action to achieve net zero, fundamental for the health of the ocean, to strongly protect at least 30% of the ocean, and make sure that all activities outside of those areas are sustainable and well managed, to ensure that there's full tracking and traceability of every activity in the ocean, and say no to deep seabed mining and destructive fishing, as well as get rid of harmful subsidies. And of course, to make sure that there is investment flowing into nature, particularly in coastal areas, to build the resilience buffers that are going to keep communities and economies intact. The bottom line is basically that we can't take the risk of being risk averse, because doing nothing is probably the largest risk that we take. So we need to work with unexpected partners to activate the billions and trillions of dollars that we need to invest into the ocean space. Right now, less than 1% of climate finance is invested into the ocean. ORA, or the Ocean Risk and Resilience Action Alliance, has been set up to actually bring together key actors so that we can break out of our silos to deliver the types of breakthrough solutions that are needed. The diversity of our membership includes leading finance and insurance companies with trillions of dollars under management, public sector leaders from the G7 to the Global South, multilateral agencies and banks, and civil society organizations working from the ground up. And together we're looking at how we can build the pipeline of investable products focused on coastal and marine natural capital, as well as construct a new global ocean financial architecture to scale investment into the space. The Stockholm Resilience Centre is our lead knowledge and science partner, and we're delighted to be co-hosting this event today. So Albert, I'm going to hand back to you so we can move to the first panel and hear what some of these key issues are. Thank you.
Thanks, Karen. Before we do that, before we dive into the fun stuff, the interesting stuff, I'll just go through some housekeeping rules, or just an agenda, so you all know what the timeline is and how we'll be navigating through this. So we're going to dive in a minute into the first panel discussion, or great lineup of speakers, focusing on the Anthropocene ocean and its associated new ocean risk landscape. So we have Jean-Baptiste Jouffret from the Stockholm Resilience Centre, Michael Beck, AXA Chair in Coastal Resilience and from the University of California, and Louise Heaps from the World Wildlife Foundation, speaking at that first panel. We'll then have a short break for 10 minutes or so, and I please urge you to stay along. It's easy when you have these virtual webinars and panel discussions to kind of leave, but we do promise that the panel discussion following the break is going to be just as interesting as the first one. Okay, so please stay along. You can go and get some coffee, stretch your legs, but then please come back. The second panel discussion really focuses on, how do we shift towards a sustainable and equitable blue economy, the key issues that Karen raised, and what's the role of finance. So we're going to have Beate Holweg, a sustainable finance expert from the European Environment Agency, Markus Müller, the global head of Deutsche Bank's Chief Investment Office, Serge Ramakis, the director of Abelobi, and Angelique Poppenot, who's Deputy Fellowship Director and Policy Advisor at AOSIS, the Alliance of Small Island States. And I do apologize if I butchered the pronunciation of anyone's name. We really urge throughout this panel discussion for the audience to participate and ask questions. You can do that from the Q&A function in the Zoom webinar, which should be at the bottom of your screens if you highlight that. Or if you don't find that, the chat function. We do prefer you to go into the Q&A function to ask your questions. And then finally, we're going to have, and we're really honored to have Helene Ågren, the Ambassador at Large for the Ocean Affairs at the Swedish Ministry for Foreign Affairs, to give a bit of a wrap-up summary and concluding remarks, building off her own work and insights for what's happening in the next 2 to 10 years to be able to kind of confront these big challenges. So it's an action-packed agenda. I won't spend any more time speaking now. I'm going to dive right in and ask the first panelist, Jean-Baptiste, to come with his first intervention. Thanks.
Thanks, Albert, and hi everyone. Pleasure to be here alongside fellow panelists, and for what promises to be a really interesting discussion. I will start where you left it, Albert, which is with that notion of the Anthropocene. You said it described this kind of epoch or event where humans have become the dominant force of planetary change, and that has impacts on the Earth biosphere, the climate system, and certainly the communities who depend on them. Something quite unique with the Anthropocene is the scale, is the unprecedented speed, scale, and connectivity among the people, among the places, among the cultures, and certainly among the economies and technologies that we're witnessing. Perhaps one of the most iconic illustration of the Anthropocene could be the Great Acceleration, the work by Will Stephan and colleagues showing across a wide range of socioeconomic and Earth system trends an exponential increase that starts after the Industrial Revolution, but really does take off in the 50s. And you see a rapid increase in a variety of variables, whether it's global GDP, tropical forest loss, ocean acidification, energy use, water use, and so on. And that has been referred to as the Great Acceleration and is often used as a marker of the Anthropocene. Now, how does that look in the ocean? Well, it looks quite similar. And that is what we call the blue acceleration, very much in the spirit of the Great Acceleration. And that represents a new phase in humanity's relationship with the ocean that again exhibits a phenomenal rate of change, but it doesn't start in the 50s. It really starts over the past 20 to 30 years with a sharp acceleration characterizing the onset of the 21st century. What you're seeing here is the ocean increasingly seen as a new economic frontier in support of 4 fundamental needs for humanity: food, energy, material, and space. And of course, you need ocean space for the three first needs, for ocean food, ocean energy, and ocean material. If you look just over the past 20 years, since year 2000, this is what the percent increase growth look like. It's staggering, right? So aquaculture has been the world's fastest growing food production sectors for many years. Offshore wind energy capacity has increased 500-fold over the past 20 years. 70% of the major discovery of hydrocarbon deposits are happening offshore and not on land. More than 13,000 marine genetic sequences have been associated with a patent. Nearly 1 million kilometers of fiber optic cables have been laid on the seabed, again, just over the last 20 years. And that carries 99% of international telecommunication. When we're zooming now all over the world, this information goes through undersea cable. It's the backbone of the global internet and of globalization to a large extent. Likewise, the annual volume of cargo transported by container shipping has quadrupled over 20 years, and so on and so on. I could mention deep sea mining, like the exploration contract. It's an area equivalent to the size of Peru that has been leased for exploratory deep sea mining. And desalination and marine protected areas are also on the go, fortunately, and so on. This is the blue acceleration. This is the new reality of the ocean. In other words, this is the Anthropocene ocean. It's this new reality that we have to deal with. Now, the Anthropocene ocean also looks like that. It's also an acceleration in the pressure on the ocean, whether it's nutrients, pollution, dead zones, climate change, acidification, overfishing, plastics, invasive species, habitat destruction. The Anthropocene ocean also look impacted. There is another acceleration that you can see here, whether it's the percent loss of mangrove area, the percent loss of coral cover, the number of strikes on big mammals, or again, the number of dead zones. You mentioned the Ipcc report. Well, the Ipcc predicts that coral reefs of the world will decline by 70 to 90% with just a 1.5 degree increase. Likewise, over the last 50 years only, we've witnessed a 70% loss of global sharks and ray population. I could go on with a lot of those different statistics. Marine heat waves are also on the increase trajectory. Recently, there was a review of noise and what's been referred to as the anthrophony, like the noise emerging from human activities in the ocean, with a variety of sources due to increased activities in the ocean. And overall, of course, the global cumulative human impact on the ocean is not only ubiquitous, but is increasing again. Marine ecosystem, and therefore the communities who depend on them, face unprecedented cumulative pressures. And that leads to new interconnected risk. We talk about a new ocean risk landscape. In the Anthropocene ocean, you can refer to as the notion of Anthropocene risk. And what's really important here is that the Anthropocene is changing the way one can perceive or address a risk. In particular, anthropogenic changes to the Earth system modify first the baseline for hazard assessment. Second, the global social and ecological connectivity modulates exposure and vulnerability, and therefore the focus for risk management. And finally, cross-scale integration can alter how and where risks are predicted and perceived. So we have to recognize that multidimensionality of risk and to recognize that ocean risks are certainly coupled and complex. There are also interactions between sectors. Interaction and conflicts among users also intensify as the ocean space becomes more crowded. An example of that in a neighboring countries from Sweden, Norway, it's one of the world's most heavily trafficked region. The seabed contains oil, gas, minerals. It's also a major commercial fishing ground. It's aquaculture hotspots for salmon farming, and it's also a hotspot for cruise tourism with Norwegian fjords. And each one of those activities predicts a 4 to 5-fold increase in isolation of each other. We know this cannot add up unless it's done sustainably. And there are two types of conflicts, mostly user-user, so the activity of one sector impacting on the other, and also, of course, user-environment conflict. Third point would be the limits. What are the limits to this blue acceleration? Are there any limits? Well, we're seeing limits. We saw limits in the mid-90s when it comes to wild capture fishery. We're seeing them now when it comes to offshore drilling with a sequential exploitation. across depth of oil and gas. We go even further as new technology emerge and shallow fields stagnates or start declining. But there are also limits that no one could foresee. This is a striking image from June 2020, in a few months only in the pandemics from Turkey, where decommissioned cruise ships are being pulled apart because it costs too much to actually have them floating. So it's more efficient, brand new ships to actually dismantle them. Overall, 200,000 jobs have been lost in the cruise industry, and one of the world's leader, Carnival, the company Carnival, lost over $10 billion just in 2020. Last but not least, and I'll wrap up here, is the notion of equity and ocean equity. There are serious concerns that exist about systemic inequity in the current ocean economy. If there is a race to the ocean, if there is this blue acceleration, then the question is who is winning it and who's being left behind. If you look at small island developing states and coastal least developing countries, their contribution to the blue acceleration, if I just cherry pick a few examples, 0% when it comes to the exponential growth you saw in offshore wind farm. 500-fold increase over the past 20 years, 0% in those countries. Marine genetic resources, 0.03. The global aquaculture, only 0.09% of the total production occurs in those countries, and so on. So I'm limited in time. I very much look forward to the discussion. And I also encourage you in the meantime to have a look at a series of reports where you can read what I just said in more details and much more in terms of who is vulnerable online. Thank you very much.
Thank you very much, JB. It's fascinating always to hear you speak about these issues. I just want to remind again the audience, please, questions in the Q&A or in the chat. But I'll start off with a question before we move over to Mike and his presentation. I just have a quick question to you, JB. You mentioned this issue of equity issues, right? That the consequences, this Anthropocene ocean risk landscape, probably won't have impacts which are equitable. I'm also wondering on the other side of who's driving this blue acceleration. Do we see any signals or fingerprints as to how equity issues within that part of the equation are playing out? Who's behind the great acceleration or the blue acceleration?
Yeah, I mean, that's a really good point. And it's kind of an intuitive one when you look at those trajectories, right? You're keen to know, okay, who's benefiting from those, or even who is driving that. And you could look at that at different levels. You could look at it at the national level, the countries. That's what I highlighted, for instance, with the small island developing states and coastal least developed countries. You could also look at it at the level of the private sector, for instance. That's what we did in a study looking at the largest ocean-based companies, the largest corporation involved in the ocean, what we dubbed the Ocean 100 by revenues. And then it's striking. What you're seeing is that most of the ocean-based sectors are highly concentrated in the hands of just a few companies. Usually the top 10 companies, the 10 largest companies in each sector, account for more than half of all sectors' revenue. And together, the 100 largest account for 60% of the total ocean economy. So you have a clear actor there when it comes to the corporate sectors. Those actors themselves require financial and require capital. So maybe that's I will park that and it will be an interesting discussion for the second session or with different panelists, because that's also a role that finance can play very strongly, is in redirecting financing towards those companies.
Thanks, JB. Thanks. It's a tricky question, but a good answer on a complicated matter. Mike, I'd like to invite you to present. I know you have some slides and you're already sharing your screen, super effective. So I'll just give it over to you. Thanks.
All right. Thank you very much, Albert. To find new opportunities to invest in nature-based solutions, we need to be able to rigorously quantify their benefits. And that's what we do for flood risk and the value of habitats like mangroves, wetlands, coral reefs, and oyster reefs in terms of protecting people and property. The work that we do is very much based on tools and approaches developed in the engineering and risk industry sectors. I'm not going to go through all the deeply quantitative approaches that we take, but you need to know that we model these benefits or these risks from offshore dynamics all the way through to consequences onshore And we look at that flooding and its consequences, both with and without habitats, to be able to quantify those benefits. And though we sum up and show global numbers, everything that we do is based on flood maps ultimately developed down at the 30 by 30 meter level or at higher resolutions. And this is an example from Grand Bahama Island showing flooding with mangroves in blue for a 1 in 10 year storm event. And then the increased flooding in red if we did not have those mangroves. And then we assess essentially the people and the property underneath those red envelopes, because those are the people and property benefiting from keeping habitats in place now. This allows us ultimately, for example, to work with folks like the World Bank and their Changing Wealth of Nations to understand the value of mangrove habitats. We also do this for coral reefs at the national level. And you can see that in terms of wealth in 2018, many nations are getting tens to even hundreds of billions of dollars just in direct flood reduction benefits provided by just one habitat, mangroves. And as Jean-Baptiste showed, mangroves have been decreasing in recent times, but even with that decrease, their benefits, their relative benefits, have been increasing over time. And that's largely because of the incredible rise in flood risk overall on our coastlines. More people, more wealth are being concentrated on those coastlines, and the value of mangroves for protecting those benefits is increasing in that time period. Because we're able to look at the value and benefits over time, we were able to work with Aura and AXXL as part of their Coastal Risk Index to identify where would we get the most benefits in restoration of mangroves for flood protection. And we did that by assessing where are the mangroves lost since 1996 that would provide the most value. So the most recently lost mangroves are where we think we can restore them in many instances most easily and achieve benefits. And we can identify hotspots where those mangroves are providing particularly high value in flood risk reduction. And then in terms of thinking about how we should be financing these options, we believe that using these kinds of data, we can better include natural assets in economic accounting. So for example, our GDP accounts for not just what we take from the environment, which is what it does now, but what we leave behind in the protection benefits. We need to rethink infrastructure investments instead of so much in gray infrastructure, particularly on our coastlines. And that includes after disasters when there are major reshapings of our coastlines and only 1 to 2% of funds in the hundreds of billions of recovery funding go into natural solutions. And we can also work with industry, the insurance industry, to provide more incentives to invest in natural capital. And thank you.
Thank you very much, Michael. And I think this presentation is also extremely topical, given the one challenge I didn't mention in the beginning is this massive and rapid rate of loss of biodiversity that's occurring both on land and in the ocean, and we're losing it quickly. So we're losing nature, and with that, the resilience of the biosphere, the capacity of the living Earth system to help humanity continue on development paths. I have a question to you, Mike, and it's a bit provocative. You speak a lot about nature-based solutions, right? Given the rate of climate change, some arguments I've heard thrown around is, why should we invest in nature-based solutions? Many of these are going to fail given climate change anyway. What would you answer people that have those concerns and questions?
Yes, well, of course, our gray infrastructure is going to fail even faster than our natural infrastructure. Most folks don't realize that while we talk about something like sea level rise, wave energy is increasing globally, and that attack on our gray infrastructure is decreasing their lifetimes. At the same time, if we manage habitats well, they will be dynamic and can even grow and keep up with sea level rise. For example, mangroves accumulate sediments, and up to certain levels, they can be growing as sea levels rise. And that's something that we can't get out of any of our gray investments. And that's just one example. We can cover more later.
Thanks, Michael. I'm sure we will. Okay, I have a bunch of questions to you and JB. I'll park those. I'm also seeing we're getting some questions from the audience. I'll save those. I'll give Louise a chance to give her intervention, and then we'll open up for questions to all panelists and also go to the Q&A, which are coming in from the audience. So thanks, Mike. And Louise, please go ahead.
Yeah, thank you very much. And thank you for the opportunity to speak today on the issue of ocean risk, which is very important to highlight, particularly as we start to take stock of the latest Ipcc report, which you just mentioned earlier, as well as all the cumulative impacts of nature and climate and biodiversity crisis that we know that we're all now facing. And whilst the ocean's natural capital does have enormous value, WWF calculated it to be worth around $24 trillion back in 2015, releasing benefits of up to $2.5 trillion per annum. The evidence is clear that eroding the natural resource base on which we all depend is leading us all towards a very high risk environment, and not least because it's affecting our ability to adapt and build resilience in a rapidly changing climate. And again, COP26 made it very clear that there will be no 1.5 degree future without a healthy and resilient ocean. And whilst this climate message is getting traction across the finance community, across the finance community, it's still not fully made the connection between climate and ocean risk, nor the links between ocean degradation and their investments and portfolios. And in fact, there was a report in 2019 undertaken by a responsible investor on the blue economy, which found that a third of the investor respondents hadn't even considered oceans to be relevant to their portfolios. And I think if we were to do that survey again, this level of understanding would have changed, it would have improved, but it still feels like we are straining under the burden of proof to demonstrate that the current development trajectory is taking us into a very high risk situation. And particularly with trillions of dollars of public and private sector finance being targeted at unsustainable and destructive practices, particularly in already damaged and fragmented coastal areas, and with the meagre investment into restoration, protection and sustainable management of our ocean's natural assets, public and private sector financial institutions do have a growing stake in the ocean and therefore escalating exposure to climate and ocean related risks. However, the risks of business as usual are rarely, if ever, priced into the value of assets. So to outline these risks in real terms, WWF and Metabolic, as a contribution to AURA, launched a first of its kind value at risk model and report back in 2001. It was called Navigating Ocean Risk. And that report aimed to quantify how financial risks arise cumulatively in the blue economy under two different scenarios, under a business as usual scenario and a sustainable development scenario. And by mapping the impacts and drivers that influence the blue economy, we assessed how the changes to physical and policy environment can impact assets and revenues across 6 major global blue economy sectors. And this included ports and shipping, fisheries, aquaculture, marine renewable energy, coastal infrastructure and real estate, and coastal tourism. And the model was applied to over 8,000 listed companies within an investment market index to obtain an estimate of aggregated value at risk. And within that index, we found that 66% of listed companies have exposure to ocean-related risks. And under the business as usual scenario, with declining ocean health and the effects of climate change, up to $8.4 trillion worth of assets and revenues are now at risk over the next 15 years. And that amount actually increases exponentially over time. But if we do take immediate action to align with the Paris Agreement and the SDG 14 targets, these losses could actually be reduced by over $5.1 trillion. And most notably, the value at risk for coastal real estate and infrastructure could be reduced by around $2 trillion if urgent action is taken to reduce emissions and preserve natural ecosystems that protect against storm and flood damage. So the report really highlights the perils of short-termism, and private sector financiers are already starting to face challenges across certain sectors. For example, I read recently that the real estate in the US market with exposure to sea level rise is apparently now selling at a 7% discount. I suspect that might be slightly worse now, in fact. So essentially this methodology aims to help financiers assess the potential future value at risk to portfolios from a changing global ocean. And what's really clear is that the business as usual trajectory does entail great risk, not only to business, but also to society as a whole. And it trickles down from private sector risk to anyone who essentially invests in a pension or stocks and shares, anyone who buys commodities transported by ship, which includes 90% of all cargo, which is transported globally, and anyone who lives within 100 kilometers of the coast, for example, and that's currently estimated to be about 40% of the global population. So pretty much everyone is impacted by these risks. And of course, the most immediate concerns are the impacts on some of the most vulnerable citizens in coastal communities. If managed sustainably, the ocean does have enormous capacity to regenerate and provide substantial gains. So to really assure this long-term social and economic resilience, we need to minimize these risks and build the resilience of the ocean. And to do that is pretty much in the hands of the financial sector to better assess their risks and permanently divert private capital away from destructive business as usual practices and towards sustainable development pathways. In terms of the model, in terms of the next steps, investors and financiers should also consider piloting sort of risk-based models and approaches to better understand the material risks of business as usual, and to strengthen the tools that are needed to inform their decisions. And then, of course, addressing these systemic risks must be underpinned by a supportive enabling environment, which I can talk about a little bit more later. And we must also support the finance sector with clear financing guardrails and guidelines to really enable them to make the decisions that align with the Paris Agreement and the SDG commitments that are in place. And I'll just leave it at that. Thank you very much.
Thanks, Louise. Such a rich presentation, and the report you allude to is groundbreaking in many ways. I have a question to you. It's tricky, but I'll ask you first, Louise, and then I'll open it up also for Jean-Baptiste and Mike to also provide any insights if they have any, if they want to chip in. But a lot of what you speak about is, the need to understand risks and define them, to assess them, but also to communicate them to the sectors that have leverage and capacity to do something about that. Broadly speaking, what would you say is the major difference in how science defines risks and the finance sector does that? How they assess risk, and how can we move towards bridging that gap? Hopefully this question makes sense. If not, I can clarify, Louise.
Yeah. Well, of course, science informs us what those risks are, and then it's how it's interpreted by the finance sector that's absolutely key. And in fact, there's a new report come out a couple of weeks ago from UNEP-FI, which is specifically looking at providing guidance to the finance sector. In fact, this was the second set of guidance that came out. The first set came out last year, and it looks at risks across a number of different maritime sectors. And essentially, it categorizes the impacts on the marine environment into a number of financial risks across those across the finance sector. So those will include physical risks, the risk to physical assets, operational risks, market risks, regulatory risks, and of course, very importantly, reputational risks. So all of those are translate into financial risks for the finance sector. And it's really important as we go forward that the science community works closely and collaboratively with the finance sector to make sure that these risks are really understood and that they are translated into financial outcomes, not just for the finance sector, obviously, but for everybody that does invest, which is all of us pretty much. I'll just leave it at that and see if the others have got something to add. Thanks.
Thanks, Louise.
Yeah, this is Mike. I agree wholeheartedly with that answer. You know, at one level, the answer feels simplistic: work together. But there's some really concrete things that we found in doing that kind of work. So we'll go about our work, and we're communicating to scientists. Scientists always want to hear more about the risk, and so does the media. And we'll put that in terms of dollar values of what could be lost and the like. But when we work with industry and others, we need to focus, one, more on solutions. Two, we found that, for example, if we take our annual expected benefits in dollar values and we go to the insurance industry, they don't want the dollar value calculation that we've done. They want us to turn it into risk reduction ratios. So we do that. When we work with the World Bank and we think about how to incorporate this in GDP, then we're not talking about annual expected benefits. We're talking about wealth, or how we turn this into a benefit that can be included on balance sheets. And at each one of these stages, it's only some modifications to the work that we do, but it's only by communicating with those stakeholders that we understand what it is that they need out of our work, and we can adapt it for them. And so again, a simple answer is work together, but there are some very concrete ways that you can do that and turn that into the kinds of values that your stakeholders need.
Thanks a lot, Mike. JB, I'm looking at you, no pressure. If you don't want to add anything, you don't have to, but if you have any reflections, please go ahead.
No, I mean, I agree very much with what has just been said. I think putting on the cap again of the kind of Anthropocene complex adaptive system scientist that I alluded to during the presentation, I think a key to the communication and addressing those risks is, again, recognizing their multidimensionality. Ocean risk today is more than just sea level rise. It's more than just hurricane and storms and floods, and those are essential, but there is more to ocean risk than that. There are geopolitical dimension. We're certainly living through it right now, but there are like other area in the world, whether it's the Arctic, the Antarctic, think of the South China Sea, but there are really strong geopolitical tensions in it. There are certainly social and equity risk. We mentioned that, and I think those are rarely factored in what is considered material by some of the financiers today, that are not seeing the materiality of those sustainability-linked risks. So I think increased knowledge on how social ecological risk ultimately do translate into financial risk, and better suited frameworks to actually measure that, which includes transparency. We might get back to that point, the need for transparency, the need for not just transparency, but also rewarding performance, and factoring in those multiple dimensions, I think, is essential.
Thanks a lot, all of you. I'm keeping one eye on the Q&As here coming in from the audience. We're getting some really interesting questions. Some of them have been answered, but it's always nicer to get an oral answer from the panelists as opposed to a written one. So JB, I'll stick with you. There's a question here by Nick Lambert, just speaking a bit about the possibility to detect or assess socioeconomic benefits by investing wisely and regenerating the environment. I think this is interesting because regenerative practices are becoming a hot topic both on land and on sea. You answered, Nikki, but you want to elaborate a bit more on your answer here so the rest of us can hear as well.
The risk is that I sound like a broken record because I'm going to bring back the equity dimension again. No, I think it really speaks to what kind of ocean economy we're having versus what kind we're hoping for, and that is maybe in line with the semantic distinction between ocean economy and blue economy, and both of those terms have often been conflated, and now where some of us are using blue economy to mean the ocean economy. Originally, the blue economy does entail a truly sustainable and equitable economy, right? And what we're seeing today as the ocean economy is far from that. What we're seeing is a very dark blue, a blackish blue economy. I mentioned earlier the Ocean 100, the 100 largest companies involved in the ocean economy today, accounting for 60% of the total value of the ocean economy. Well, 47 of them are oil and gas companies, and 9 out of the top 10. Right, so there's a clear mismatch so far between the aspiration of a truly blue economy and the reality of extraction from the ocean. Now, putting that reality aside, yes, I do see social benefits, and we have some already. Like if you pay attention to the blue acceleration, not all of those curves are cause for despair. We have marine protected areas, if done well and if done together with local communities, can be really positive and can provide benefits to the communities. We have I mentioned the submarine cables. That's one of the activity in the ocean that has probably the least impact versus the actual benefits that it brings in terms of global communication, access to information and infrastructure. We also have offshore wind farm. It does come with a few challenges and impacts on the environment, but again, if done well, it's one of the most promising alternative of offshore renewable energy today, at least the only one that has been scaled commercially. So the short answer is yes, there are a lot of socioeconomic benefits to envision from an ocean economy done well. And this is, I think, here on the panel, what we all are working towards. And the guidances that Louise mentioned from UNEP-FI are also going into that direction, right? Giving guidance to like what sectors actually do belong to a truly blue economy once again. But it has to be done right environmentally, and it has to be done right with the people who depend on it and who ultimately will benefit from those, from those accumulated benefits from the ocean.
Thanks, JB. I think I'm going to stick on this topic here as well. Then I see there's a few questions coming in around ecosystem restoration and how we get investments to support that. And I'll save those and then address them to Mike to begin with afterwards. But I have a follow-up question to Louise, which builds on this issue that we're focusing on now, which is equity and benefits. Louise, I mean, it'd be really interesting to pick your brain and hear your thoughts on how we can start to ensure that sustainable finance really begins to trickle down towards coastal communities, given their massive and high social and economic dependencies on the ocean and the risks that they're facing, and just building off some of the work that you've been doing as well in that sector.
Yeah, thank you for the question. There's really no silver bullet to this question, but I think it's important for us to really recognise that coastal communities, particularly in the global south and east, have a critical role in safeguarding coastal ecosystems. So delivering social, economic and environmental resilience across coastal ecosystems and dependent communities is going to require quite a substantive amount of investment and dedicated capacity building. So it's critical that as sustainable finance starts to be mobilised, that it does reach coastal communities and empowers them in a way to develop in a way that builds and sustains the resilience of the ecosystems that support them in terms of course, food security, livelihoods, coastal protection, cultural values, and so far. There are quite a lot of challenges to this finance flowing, as we are very aware of. And, obviously a lot of them are very small. They lack appropriate deal size and risk return ratios to match available capital. They have high transaction costs, low or slow return profiles, dispersed and fragmented nature, and the list goes on. But poor governance is also a major issue. Not least is the capacity challenges that are being faced in order to create investable enterprises, essentially. So consequently, there's really not sufficient scalable and investable pipeline available at this level. So a new incubator and accelerator services may be the answer and the solution to strengthen capacities and to build these business models. And they can also be used to aggregate enterprises and projects in a way that will make them more palatable, I guess, to the sort of larger scale investment. We also need to think about the enabling conditions that need to be significantly improved in most cases to attract this finance. I think it's really critical that community voices are heard to really inform and shape the policies to enable financial flows, particularly in terms of securing equitable rights and tenure, and to supporting strong governance and equitable benefit arrangements. New finance mechanisms can also be quite helpful. So things like the parametric insurance sort of products might also help to improve the risk profile and also incentivize best practice at that level. So we're actually in the process of identifying a number of income generating and cost saving opportunities across the Southwest Indian Ocean and the Mediterranean at the moment. And we've come up with a number of sort of prospects, if you like, around, none of them come as a big surprise, around community ecotourism, mariculture, seaweed farming, for example, small-scale fisheries, cold chain and supply chain development. And in fact, we identified 28 of these projects in the Southwest Indian Ocean. And whilst these projects, you know, do demonstrate the ability for scale and replication, they're really very much pre-investment ready, and they rely very heavily on grant funding. So over half of these projects are undergoing feasibility testing and piloting at the moment. So actually, they're not that far away from being investment ready, but they will require further support. In fact, they all need support in terms of capacity building, in terms of technical support, business planning, investment support. And as those enterprises then become sort of more investment ready, if you like, they will require development funding and seed finance. And I think most importantly, as I said earlier, they really need this robust strategy and governance in place, really to mitigate potential sort of project specific risks, to align project needs and objectives at the regional level and ensure that resources can be effectively distributed and prioritised across this sort of portfolio. And again, I think the key here is about aggregation. If they're so small, you really do need to think about how you're going to aggregate those projects in order for them to be palatable to investors. So just finally, we did commission a study also by Finance Earth. We're working closely with Finance Earth on all of these things, on whether there were already incubators and accelerators out there. And in fact, there are, obviously. We found 24 big accelerators that are already functioning, but none of them were really focusing on the small scale community level. And so they're all sort of high growth sector largely. So that there is a real sort of challenge there. And our process now is to try and develop an incubator that's really is focusing on this kind of smaller scale and working with the local stakeholders to do so, and supported actually by Aura, a project that we're doing through Aura. So I think it is incredibly challenging, but it is really important that we do this. I mean, 80% of the world's business is small to medium enterprise. We can't ignore it. And the majority of what's going on in the coast is done by very small scale community level. So we need to find an answer, and I think all of us sort of putting our heads together and trying to work out how to do this is going to be the key. Thanks.
Thanks, Louise. Yeah, this is a rich part of the discussion we could have, and I'm sure Mike and JB have itching to contribute, but I want to make sure that we do address some of the questions that are coming in from the audience as well. And there's a couple that are coming from Guillermo Tono Crespo and Nadia Papadopoulou, which deal with, you know, regenerating lost habitats and nature. So Guillermo's question, I'll start by addressing them to you, Mike, and we'll see if I have time for JB and Louise to pitch in as well. But Guillermo's asking how we can make a more explicit connection between the UN Decade of Ecosystem Restoration and the UNFCCC nature-based solutions on the topic of blue habitat. A very easy question to answer. And Nadia alludes to, I mean, how do you get, it's the magic question, right? How do you get investments to increase in support of regenerating nature? So, you know, much of your work, you've probably seen that a lot of investment just goes back to building gray infrastructure, right? How can you change that surge of finance towards restoring the natural habitats that can build resilience?
Yep. Well, yeah, there's a huge amount of questions kind of contained in there. I'll note, well, sometimes I don't know how to explain people's priorities. I'll leave part of the answer at that. But right now, the thing that I find most challenging is that we've got so much concentration on mitigation, when I really believe that, which will help in our long-term future, absolutely. But we've got to help communities adapt now. They are facing real risks right now, and what we need to do to be able to reduce those is critically important. And so, from where I sit, the best thing that we can do in terms of helping folks align priorities is to help show where they could get the most bang for their buck in terms of either protecting people or property. And again, this is a little bit of a difference here because we've shown that depending upon what your priorities are, if your priorities are to protect economic values, then you will focus on coral reef and mangrove conservation restoration in some places, and that will be very different if you're focusing on protecting people and particularly vulnerable people. But by being able to quantify those and show where those investments could best achieve either of those goals, that's how we hope most to be able to drive further opportunities. That's the shortest answer I can give.
And Mike, you want to tackle the connection between the UN Decade of Ecosystem Restoration and the Ipcc?
Well, here again, I think, there is a lot of interest in being able to quantify, for example, where mangrove restoration is going to do the most for carbon sequestration. I think the opportunities to align the places where you can get the most sequestration and the most risk reduction or climate adaptation benefits will be one way to create that alignment. At least have folks be talking in similar terms, understanding the needs of restoration, the long-term needs of keeping that restoration in place. I think as long as we're having folks talk in the same frame, then we have the best opportunity to align them.
Thanks a lot, Mike. JB and Luis, before we move on to maybe the final question, before we break, Joe, anything to add to that specific question, set of questions?
I can just flag one thing, which is like something that's relevant to the nature-based solution, in particular the discussion on blue carbon or those blue habitats, is that you're not killing two birds with one stone, but you might be saving two birds with one stone, which is that a lot of the discussion to date has been focused on climate, and we've seen momentum in the financial sector over the past 5 years, maybe a bit more, maybe a bit less, on climate risk and on really trying to address climate and setting science-based target for decarbonization and so on. Biodiversity is more or less today where climate was 5 years ago, and it's gaining rapid momentum. And I think those blue habitats that Guillermo and Nadia are touching upon, they address both. They're not just, efficient and effective and useful for climate mitigation, but they're also sources of really rich biodiversity, which can have a lot of benefits, not just for the local communities, again, if it's done right, but also for more of the private sector, if you think of reaching targets, which will take some offset in the short term. The question is, do we want an ocean-based companies to offset to reach a target by planting trees somewhere else and privatizing land, or do we want credible offsets, which benefits not just climate reduction, but also certainly marine biodiversity? So there's a really strong potential there. The market isn't there yet. And so that maybe brings us to a different discussion, but one way to link it is to also strengthen the appetite and the actual market for those ecosystems.
Yeah, I'll come in now, actually. I think what we don't do enough is talk about avoided costs. And I think that really clearly does provide a clear sort of route forward for why we would want finance to flow into supporting natural ecosystems. Mangrove restoration alone could save an estimated 65 billion per year in terms of storm and flood damage. And then there was a really good example that came out of the Earth Security Group report from Pakistan, which revealed that restoring mangroves on site could save the project developer. It was a wind farm that had invested in a mangrove project, could save the wind developer and its investors up to $7 million over the project's lifetime. So there are, sort of clear benefits here of investing in our natural ecosystems, in natural capital, and the avoided costs are significant. So I feel like that sort of discussion needs to be built further. We need more science. Again, the burden of proof should be reversed, but unfortunately we still have to sort of show what these benefits are. Climate finance still falls short significantly for oceans, so that needs to really change. And there needs to be greater coordination across the existing global governance frameworks so that we can extend the current focus of climate finance to more explicitly include coastal and marine investments that could provide climate benefits alongside sustainable blue economy benefits. Just in terms of other types of finance, new innovative finance mechanisms are sort of coming on stream. We are currently doing a study on blue forests, assessing the status of blue forests at the moment and the potential pipeline that might be available, and the potential financing mechanisms that could be developed to support that pipeline. And essentially, we're looking at stack services, not just carbon credits for that. But I think there are a lot of opportunities. But again, this community, and the science community in particular, is going to be really important to help us think through and find those mechanisms that are going to really work. I'll leave it at that. Thanks.
Thanks, Louise. And I think that's also a perfect segue to take a break now, a 10-minute break, and then move over to the second panel discussion, which will be focusing on some of these new innovative financial mechanisms. Hopefully, they'll be taking that up. There's still the Q&A. It's bubbling in the background. So if you haven't caught some of the stuff happening, I recommend the audience as well to go in. There's some questions that have been answered directly in the Q&A box there. I really urge you to stick around now. We're not done. We're only halfway. This is just a half time, but we take a 10-minute break to get some refreshments, stretch our legs, some energizing snacks, some coffee. Just keep sticking around. Come back, and 16:40 CET, we get going with the second panel. Thank you so much, and thanks to the panelists for this round for a really rich and entertaining and invigorating discussion. Thanks a lot.
Okay, welcome back, everyone. I think I'm just going to kick off with the introductions to our next panel. That was an absolutely fascinating discussion, really kind of setting the tone for an understanding of what is happening in the ocean space, both in terms of the private and the public sector, looking at the big picture, as well as impacts on small communities. And the four experts we have with us now are really the practitioners working in the field, trying to focus on how do we activate the finance, the investment into the space, and what are some of the challenges, the hurdles to doing that, but also the opportunities. And I think, we've heard some really interesting remarks, and through the questions, a focus on how do we avoid some of the costs that are coming at us from ocean risk, those multi-dimensional factors that Jean-Baptiste spoke to, from the political risk to some of the risk multipliers from land to liability risk and other issues that I know that Mike spoke to as well. Looking at also some of the opportunities for investment into stacked services. So not just focusing on one element, but looking at a biodiversity positive as well as a climate positive investment, and the opportunities for that in the ocean space, but also recognizing, of course, that we have imperiled ecosystems to date. And so we've got a lot of work to do, and a lot of work to do really quickly. So our 4 experts today in this second part of our webinar really come from private sector, public sector. Serge, who is working at the small scale community level, and Angelique, who has been working in the Seychelles on some of the most cutting edge investments that have been made there, but also looking beyond that to other small island developing states. And we're going to start with Beate and then lead off to Marcus. Beate is a sustainable finance expert working with the European Environment Agency. And Beate, it would be excellent to hear from you some of the work that is actually being done. And I know when I first started engaging in the finance space, I could not understand why finance experts were talking about taxonomies and thought that maybe had to do with the classification of creatures, but how important those taxonomies are to ensuring that there is disclosure and accountability for the investment frameworks that are being developed. So let's head over to you first for an introduction to this fascinating topic, which is not at all boring once you figure out how important it is.
Yes, thank you very much, Karen, for this kind introduction, and thank you for having me. It's a quite timely and really webinar, and it's about a topic that is really of importance for all of us. When it comes to the taxonomy, thank you for this kind description of this topic. I know that the term is not that well selected, so to say, because some people are thinking of a species and other, maybe also on taxes or whatever, but not on the classification of sustainable activities. And that is what a taxonomy is all about. A sheer classification to help the investors to understand what of their investments are sustainable and what are not sustainable. And this exercise has started in 2018 when the EU Commission called in an action plan for sustainable investments and realized that we need a clear guidance for investors to distinguish between different investment files. And so we are in the situation now that we already have one climate-related taxonomy in force that is a very good list of activities helping investors to come up with business cases and put their money into the right direction. Currently, we are working on an additional taxonomy related to marine resources. And that is the reason, I guess, why we are talking here about this issue. We will come up with some, or hopefully we will come up with some clear criteria that, that make this sustainable case for flood and drought risk prevention and protection for coastal waters or remediation activities, and maybe also for marine transport. As you can imagine, this work to distinguish between unsustainable and sustainable activities take a lot of effort from experts all over Europe and from all different areas, from stakeholders from the financial sector, but also experts on the marine ecological systems, and also experts on the companies doing business in this area. We have been negotiating for more than 1.5 years all those activities. When it comes, for example, to fishery, you can imagine there will be some also political issues here, also some issues related to the social aspects, jobs, employment, all those things are of importance here. But when we are sitting together in the so-called platform on sustainable finance, we are delivering only the technical input. And we will come up hopefully with some proposals for the Commission, because the platform itself is only an advisory board to the Commission. It's up to the Commission to decide how the finalized list of sustainable activities looks like. And there will also be some thresholds and guidance on fishery, as I said, hopefully on marine transport. But there is more to do, so to say. We, for example, we identified that also in the mining sector, there are some, there is the need of guidance, what mining activities could be claimed to be sustainable or not. But so far, we haven't had the possibility to finalize our negotiations there, and this will go on. So, and the platform will enter in the second term in the second quarter of this year, and the negotiations will go on. I have to admit that I'm aware of about 20 taxonomies underway globally, meaning that Europe is not the only space where we are discussing what is sustainable and what not. And it is also important to keep in mind that our solutions might not be the same as the solutions in other areas. I'm aware that the Chinese people, Republic of People have delivered a taxonomy, the Russians have delivered one, but also South Africa and also Canada, etc., etc. So the process will go on. It is also important that this is a voluntary instrument, meaning people can rely to it, but there is not, we are not saying that if you are not part of this taxonomy, you are not sustainable. It might be that you are not yet covered by the current version of the taxonomy. In the end, we hope to cover the whole blue economy, but so far we come up only with a certain activities, as I mentioned, marine transport, fishery protection, for prevention, flood and drought risk prevention and protection for coastal waters, and remediation activities, especially the sustainable use and protection of marine resources. So,
thank you. Thank you, Beate. It's really interesting in terms of, as we look to drive investment into the space, and Marcus, I'm going to turn to you as we think about this. So the development of these taxonomies, to help incentivize banks like Deutsche Bank to invest in nature positive, ocean positive investments with a level playing field, to understand what the rubric is for that investment, and help with transparency across the sector. That's in development. As we've just heard, it's not just the EU that's looking at developing a taxonomy. There are many around the world. You are working in the space of one of the largest private banks in the world. Obviously, there's the sovereign investments as well as private investments that you've made, looking at how to be the kind of actor that can invest into this ocean economy to drive it towards that more equitable and socially sustainable, environmentally sustainable state that our previous panelists were suggesting. How does that help or not help you, and what do you need in order to really get these billions and trillions of dollars that we want to see into the space moving?
Yeah, so thank you, Karen, for this very tough question. Yes, so I will provide this solution quite soon. So give me just 3 minutes and I will provide you with a solution. So the solution is really wrapped by a nice story. Let me really just lip read this very nice story to explain my thinking. So there was a father, and the father has left 17 camels as an asset for his 3 sons. And then the father passed away, and his sons opened up the will of the father. And the will of the father stated that the eldest son should get 1/2 of the 17 camels, The middle son should get 1/3 of the 70 camels, and the younger son should be given 1/9 of the 70 camels. And it is not possible to divide 17 into half, or 17 by 3, or 17 by 9. So the sons started to fight each other and to find a way how to solve this problem. There was a wise woman, and they went to this wise woman, and they have asked this wise woman this question. And the wise woman had 1 camel left, and now they had 18 camels, so that it could be divided by 1/2, by 1/3, and 1/9. And the surprising topic was that at the end, 1 camel was left, which they could give back to the wise woman. And this story tells me exactly what we need. So the attitude for problem solving, which we clearly have here, is to have a common ground, point number 1. So taxonomy is very important for this. The second topic is understanding that these issues can be solved. If you do not understand that the issues can be solved, you don't seek for a solution. And these are the main important ingredients for me, really understanding what's on the table. So we as financial institutions, we need to know from our clients, so the ones who we lend to, the ones we give finance, we need to know informations to assess the potential risk of this finance activity. But those companies, for instance, or countries, sovereigns, need to understand as well how to disclose those data, the risk. And I don't mean the midterm risk or the short-term risk, I mean really the long-term risk, because this is what we are currently talking about. And at the same time, the investors are demanding this. What I don't know, I don't invest in. And we need to be clear, what we are doing as investors at financial markets is clearly the following. We assess information to build, based on these information, expectation about the potential outcome in the future. If we don't have these informations, we won't be able to build any expectation. So all these things must fit together. But the problem is, and I just tell you some facts, I'm not a numbers person, as you might know, but some facts. We've surveyed our clients around the world in 10 countries, and we are running the survey again this year. And just 23% of the clients, of the business clients we've asked, have a dedicated biodiversity strategy in place. 23%. It's not a lot. And then secondly, we have a differentiation to make between the global areas. Environment was a topic just in Europe. In the Americas, we had a social topic, and we know this from Black Lives Matter and all these social topics and problems they have to solve. They have a complete different focus. And in Asia, it's governance, because the economy is growing and they need to know how to grow the economy in a more stable way. So therefore, they put governance at the center stage of the discussion. So means we have a challenge of different activities in the world. We have the challenge of a common understanding of the problem. And we have one other challenge. 95% of the employees, or not 95%, even more, 99% of the employees are employed with small and mid-sized companies in our economies. And 95% of our economies are mid-sized companies. And just a tiny bit are the blue chips. And we need to turn these mid-sized companies into the green chips of tomorrow. If we don't support them, if we don't help them, we won't solve this conundrum. And at the end, we have to finance every year roughly 180 billion to close this gap. And this is just to solve our current problems. And we should not achieve for the oceans a similar goal as net zero. Net zero is not enough. We have to invigorate the natural stock. And we also need to find a way to measure economic success differently than we have done in the past. And if we do all of this, so simply not much, we will have solved the problem. But I think then the finance will flow in this direction, but we have to reduce this information asymmetric profile we currently have globally, and then the solution will be developed. Last word, one solution I clearly believe in is nature-based solutions, what we already have talked about, but also the way of the tokenization of nature-based solutions. We not need just to do the things differently, we have to develop in a new economic way. Just repeating the past, adjusting our economic reality of the past to the future won't be enough. Economy will be completely differently defined in the future. And we should not forget, the problems we have to solve are the problems of our global commons. We just have once. And there is not the tragedy of the commons, there's the tragedy of the governance. And if we don't solve this, we will feel like the turkey in front of Thanksgiving. Also at the last day, the turkey thinks that he will get feeded again. And then suddenly it has happened. So this is the risk we are running into, but we can solve it.
Thank you, Marcus. Thank you for bringing turkeys and camels into this discussion as well, because I think
diversity, right?
That's very novel. It brings a whole lot of biodiversity onto the table. And I'm just wondering, before we kind of shift to some of the really practical things that are going on, for you looking at this and the potential investments that, you know, some of the large banks, the large asset owners and managers could be going into in this space. You've spoken about nature-based solutions and how we need to generate that marketplace, but what do you see as the most viable potential opportunities for investments to help accelerate towards an ocean economy that is more sustainable rather than continue the business as usual trajectory, which Louise detailed for us, puts so many assets at risk?
Yeah. So one thing is companies who do stop some activities. So what you also have mentioned in your introductory words. So there is a limit, and the companies have to stop some activities. This is quite clear. So and those companies need to disclose this, and they will see the benefits from the investor's point of view, because changing the traditional business model means acknowledging there's future risk, because we know that if we don't acknowledge nature in our activities, we have either reputational risk, liability risk, physical risk, or even reputational risk. So this is one part. So we need to stop certain things. Secondly, we need to find new areas for doing activity, but not just doing it as in the past, reflecting our economic impact for nature. Means maybe the carbon absorption stuff with kelp can be one idea. Mangroves, reinvigoration of coral reefs can be another idea. So the return won't be a direct financial return, it will be a natural return. But if we disclose, make this return transparent, individuals get an incentive to capture this return. Thirdly, sovereigns can get differently treated based on their ratings, debt ratings, for instance. If they manage their country and their entire liability structure differently, also in the context of biodiversity or nature-based solutions, maybe there is a potential rating or debt relief possible in this areas. And we have seen from Belize and from some other examples during the last month a lot of things. And lastly, on these other stuff I've just have mentioned, investors will turn their attention to if they see that the risk is getting reduced by a prudent management of those risks of companies or countries. Investors will shift their money towards these less risky, potentially less risky assets. And per definition, if I depreciate some activities, I automatically look for new opportunities as a company. So stopping leads to doing something new, but we need to define new. Last word to this. We not just need to innovate. And innovate, I mean putting an electric engine in the same vehicle as we have used for the last 100 years. This is not changing how we live. This is just doing it differently. We need to change things, something which is terra incognita. But these opportunities bear financial opportunities as well. And those companies I would immediately appreciate.
That's great, thank you. that was, I kind of took a 5-point plan out of out of some of that, which I'm going to try and sum up later. But I'm actually, I was going to reach into Serge next, but I think your comment about the credit ratings and countries, Angelique, makes me have to turn to you at this point in the conversation, because we have seen, for example, with the debt for nature swap in Belize recently, with the insurance risk wrapper that went with it, an increase in the credit rating of the country as a result of that shifted investment there, which is exactly what, I mean, that is, a fantastic example really of how innovative finance into nature-based solutions, which also invest into the communities and rebuilding nature in Belize, means that the whole country can see its credit rating increase, which offers all kinds of economic benefits. You have been, really at the helm of the debt for nature swap and the blue bond in the Seychelles, and are now looking more broadly at AOSIS or some of the small island developing states and what can be done there. Share with us some of the lessons that you've learned and the opportunities that are now on the table for potential investment in the space. Maybe we can get Deutsche to invest in some of those places, and we're not only feeding into Stockholm Plus 50, but we're helping to drive some investment as a result of this webinar.
All right, thank you very much, and thank you for the invitation. Deutsche, we're always happy to speak, so open invite there. No, so to your question, Karen, I think absolutely, when it comes to small island developing states, we've seen that one of the ways of addressing our macroeconomic challenges has been through innovative sources of financing. And I think it's also particularly relevant to highlight that there's a reason for why certain SIDS or certain island states actually embark on these endeavors. One, of course, is the macroeconomic situation. Also the debt situation, the external debt that we have with external creditors. And the other aspect is also thinking about our access to finance. So one of the things that I think is always worth highlighting is you will see countries like Belize, you will see countries like Seychelles, as well as other small island developing states start to explore innovative sources of financing, because we no longer have access to concessional financing or grants financing. And it all makes sense for us to explore blended finance in the framework of nature-based solutions. Most of the time, all of the time, many of our islands are, of course, dependent on the ocean, as a foundation and bedrock for our economies, but also social well-being of people. And as such, that is where the deal not only economically makes sense, it makes sense for people as well as the country more broadly. Karen, if I may, I wanted to touch a bit on the equity aspects of blue economy and these finance deals. So one of the things that I think is particularly important is to think about how are we making sure these deals are ultimately moving away from business as usual. How are we making sure that these deals are just not repetitions of what's been seen before? Otherwise, what are we really doing differently? And this is where it's important to consider beyond just the numbers. There's a phenomenal number. I think it's more than $300 million for Belize now. I mean, really a scale up advice, that lessons learned that we've been giving from Seychelles is you need scale. And in terms of the numbers, definitely Belize, over $300 million for a blue bond, definitely that scale is there. But one of the things, and this was emphasized earlier on from Louise, is capacity. If we truly want this funding to actually deliver as it relates to both social equity and ocean ecosystem health, we're going to need to invest in capacity. Now, I've been trying to push, and I don't know if anyone's listening, but one of the things that I've been trying to say is, in the same way that and I'm a lawyer, so, not trying to take anything away from lawyers, in the same way that we invest in legal fees as we go into a deal, we need to think about, if we want our deal to be successful, in the same way that we need to dot the I's and cross the T's, in order for our deals to be successful, we need to invest in capacity in local communities on the ground as we go, before the deal is signed, because that is going to be critical to the success of these deals. What can happen alternatively is you're going to have a lot of money sitting in an account, and there's not going to be unlocking of these funds or access to these funds. It is one thing to have funding available. It is completely different to have it accessible. Now, one of the things that it's perhaps one of my proudest achievements whilst I was the CEO of the Seychelles Conservation and Climate Adaptation Trust, is when I came in, I said, everything all our communication materials has to be in the Seychellois native language. Language should not be a barrier for you to access finance, for example. You should be able to write an application in your local language as you are best able to communicate. I rather we use the funding to make sure Deutsche and the World Bank and everybody else can understand later on and have that work translated. But let us not have that as a barrier upfront. And we've seen, we've seen results. Whilst I was there, we saw more than 50% of grants were led and managed by women. They were being implemented, the projects were being implemented by women. We saw, it was a third when it came to young people, but we definitely saw an increase in comparison to when we started. So one of the things that I think is worth emphasizing is also, when we think about capacity, we must not only think of it as the capacity to complete all the bureaucracy that we put in place that makes us somehow feel that the money is being better spent without many layers of applications and many layers of reports. Yes, that's important capacity to build, but at the same time, we need to think about capacity to actually make that difference on the ground. And finally, my point is, how do we measure that these deals are actually working? We've heard a lot about the numbers, and numbers are important. But at the same time, how do we make sure that these equity outcomes are actually being achieved? Oftentimes, those are not thought about at the beginning. And sometimes, yes, you say protect 30% of the exclusive economic zone. And sometimes we feel content when we get to the 30%, but it has to go further, right? It's about making sure that there is quality of that, there's actual protection and not, the drawing of lines on a map. But when it comes to social equity, it becomes even more challenging. And I think what's important is that we don't think about that only when the donors ask, okay, so how many people have got new jobs now? And that's usually like at a midterm review or something. We really need to make sure that these are thoughts that we're having at the very beginning. And the best way to put that in place is to have a clear monitoring and evaluation framework at the beginning that includes environmental ocean ecosystem health, as well as social equity principles. And then, of course, the deal will always outline in the contract when the repayments have to come through, what's the return on investments. Those things are always clear. But I think, we need to move a step further. I think there's still some legwork to be done to make sure that blue economy does not deliver just on the economic side of things, but also true environmental ocean health, as well as social equity. Thanks. I'll leave it there, Karen.
Thank you. So interesting, honestly, and just fascinating to hear about your experience in real implementation. And I think, I think one of the things we in the ocean community have to learn is from the climate community, and particularly those folks who are working on resilience. So a little shout out for our colleagues from the Global Resilience Partnership who are co-hosting this webinar as well, because they're actually working at the moment on measuring, on generating resilience metrics. so that it goes beyond the economics, but looking at the social and environmental elements of those metrics, which I think are going to be so important, particularly, again, as we shift to think about some of the environmental investments in the blue space and in the coastal space, where we can go beyond, as Mike and Louise and Jean-Baptiste were talking about earlier, carbon offsets, to think about resilience values and how we measure those and incorporate in the measuring of those values the benefits that can then accrue to local communities from either the sale of resilience credits or something like that, but helps keep those communities intact and mitigates some of the harm to them, which is going to be critical. Again, going back to what Jean-Baptiste was saying, if we're going to address some of the bigger geopolitical threats from things like migration and displacement. And Serge, to turn to you, which this may seem like a leap, but it really isn't, in working in South Africa, looking at and beyond really, small-scale fishers. There are hundreds of millions of small-scale fishers around the world. Many are on the edge in terms of both their kind of social as well as their economic resilience. And seeing how, with a combination of technology and fintech, we can actually help build the resilience of those communities. Tell us a little bit about the work that you and Abelobi are doing, and share with us how, from this discussion that we are having, you can see the opportunities for investment in the space to help build the resilience of those communities as we look to a more equitable ocean economy.
Thanks, Karen. I lost you there for a minute, but I think I got the gist of it. And thanks as well for letting Angelique go ahead. It really inspired me. It kind of got me going. So that worked out really well. So Karen and everybody else, again, thanks for inviting me. It was a nice surprise. And I'm going to really try and situate my contribution in as you said, in the action space. I'm going to be using an example that I'm heavily involved with, as you know, but I'm going to use it to share how I think we need to frame this idea and the need of channeling finance to stimulate the blue economy, but at the local level and also within a blue justice framework. So as many of you know, I'm involved in a social enterprise called Abelobi, based in South Africa, but working in many other countries as well. And we work very much in that small scale fisheries space. In essence, we run a co-designed ECDT platform, electronic catch documentation and traceability platform. And we've appended a digital marketplace to this with digital transactions and financial services. We deploy this ourselves as a development intermediary or with partners elsewhere around the globe. But our deployment model is very much linked to our impact model, where we strive for fisheries rebuilding and sustainability using a triple bottom line approach, looking at the ecological, the social, the economic dimensions. Our model is also one of embeddedness, where the platform sellers, the platform workers, to use that kind of language, form part of the governance structures and the growth plans of this whole thing. Users own their own data, and in essence, it's really all about trust and legitimacy. There are no shortcuts, in our opinion. We often speak about scaling out and scaling up. In fact, a lot of today was about that. But in our experience, we need to pay equal, if not more, attention to scaling deep if we are to foster any resilience in coastal communities. We run these hubs in fisher communities that create jobs for women and youth, and where fishers can connect with that digital marketplace to access a fair market, being chefs, home cooks, retailers, etc. But Karen, on the back of this, we run various financial services, including to women post-harvest workers, as we know.
Oops, I'm not sure if everyone's having the same problem. Serge is just frozen. as things were getting really interesting, and so I'm going to interrupt a little. I hope there's not a power break in South Africa, which is something that happens on an irregular basis, and unfortunately will mean that he might be a while in joining us. But I think the work that Avalodi is doing. Oh, Serge, you're back. Okay.
Karen, I'm back. I have a good stable internet, and somehow I've got a bit of bad luck now. So apologies. I don't know where I left. I was kind of into it. I don't know where you lost me. So if you can help me out, then I'll carry on.
Sure. You were talking about how the work that you're doing is both with small-scale community fishers as well as women, and bringing them into the mix.
Got it. Thank you. So we run these hubs where we deploy this technology, this program, but on the back of this, we are able to to channel various financial services, including to the women post-harvest workers that are part of this process. We run various kinds of entrepreneurial and financial training. We sometimes see ourselves as an incubator of small businesses, and then again, through this data framework, try and look at opportunities for fisheries improvement, working towards sustainability. And we really see this kind of model as critical to channel, curate financial services in a more ethical and equitable way and with effectiveness. Think about microloans, working capital, but linked to marketplace transactions so that repayment is realistic, credit scores match seasonal livelihood activities. We see financial service products initiatives for and to coastal communities too often fail. And we really believe that they need to be wrapped. We're testing it in our own kind of platform and model, and that enabling environment is really critical. Why? Because it, again, allows us to channel that finance all the way to the coastal fishery sector, where people derive a livelihood from the ocean, some with entrepreneurial aspirations, but where real social and environmental and market challenges exist. I mean, we've seen it and we've talked about it over the last hour and a half, but most current finance doesn't get all the way to coastal livelihood development. We've seen it in the work and the studies that WWF has recently really done, and coastal livelihoods they're not investable businesses the way we're currently talking about it at these kinds of fora. Looking at investment readiness, looking at return on investments. They're livelihoods. Only a percentage of them are micro enterprises who need microfinance and other very tailored financial services. So as Luis said in the previous session, I do think that there's a role to play for these kind of more transparent aggregators, incubators, intermediaries. These could be fisher cooperatives.
Excellent, thank you. I'm so glad we managed to get you back, because I think what we've done, we've kind of gone almost around the world from a very top level down to the folks that are working in coastal communities. And I wonder if, Beate, I can shift back to you, having listened to our fellow panelists, and this may be a big question to ask. So I don't think you have to answer it yourself, but I think this is a question for all of us who are participating in this webinar, which is taking on board some of the points that were made by Marcus, by Angelique, and by Serge. How do we begin to incorporate some of these elements into the types of disclosure mechanisms that are being developed, the transparency that the taxonomy is developing, so we can make sure that we're not only enabling disclosure in the current economy, but we are shifting towards the new investment paradigms that all three of the other speakers have spoken about, that we need to shift towards, so that we can value nature differently, that we can value coastal livelihoods as part of those investments, and look to actually shift the development of this ocean economy in a more sustainable direction.
Yeah, thank you very much. It's quite an amazing discussion we are having here. I'd like to add one initiative. This is that is currently underway. This is the review of the so-called non-financial reporting directive that will end in a so-called corporate sustainability reporting directive. And under this political development, the EU Commission has assigned a new European standard setter that sets out to develop a whole bunch of sustainability reporting standards. And one of these standards will be related, or one of the questions in those standards will be related to marine resources. So this is foreseeable, and we are currently working in a board together with technical experts on developing those standards, and we will submit it. There will be a public consultation, I guess, around end of March or better end of April. And those standards will then be submitted to the Commission, who will take this advice and build up some sustainability reporting standards for huge and medium-sized companies. And the second step will then be to develop sector-specific standards, meaning that we address companies doing business with fishery, marine transport, coastal, what we heard about, I do not know, business cases to increase the urban reliability on marine resources or such things. It is not fully decided on what sectors we are addressing, but in the end, we will at least come up with a meaningful bunch of sectors that we will cover in this second step. And this will happen till mid next year, and then the Commission will develop those standards. Unfortunately, the first period where companies need to report according to this standard will be 2024. So the first effect, we guess, we will see in 2025. So this is a midterm, so to say. But this whole initiative on reporting directives, also on the taxonomy, and there will be used to guide financial flows into the right direction. There are two additional, at least two additional things that I'd like to mention here. One is the Green Bond Initiative that is based on the taxonomy, and you need to use all proceeds in order to finance sustainable activities classified by this taxonomy. And the other one is a possible upcoming EU eco-label on sustainable financial services that is also related to the taxonomy. But in the end, coming back to what Markus has said, we need to get more information out of the companies. We need to understand how do they do their business. And when we are developing those standards, there is an important difference from what it was before. We do not only require the companies to report the financial impact of environmental degradation. That is what's happening all the time. We also require the companies to report their impact on the environment and set out some targets and strategies to improve their environmental impact and their sustainability prospects. So what we think about this is that by doing or claiming those requirements, we are able to finance transition. Because in the end, as Markus has said, if we know this company is doing business in an unsustainable way, then the financier will take, that's the hope, the money out of the business and put it into the other companies. Therefore, what we really need from Angelique and also from Serge is an idea, what are sustainable business cases? We need to understand what is in there. How can we build up an understanding of sustainable economic activities in this world? Because
thanks, Beta. I'm going to stop you for a second there. Thank you, because I've just looked at the clock and realized we've only got 3 minutes left in our session. So thank you. And I think that's a great segue, both Angelique and Serge, if you each take a minute to think about the challenge that's really been thrown. But also I see there's a question in the chat, which maybe Angelique and Marcus, you can also answer in terms of the potential risks from blue bonds and how to minimize those risks, particularly focused on privatization of public goods and promoting the interests of multinational firms at the expense of local economies and businesses. So how do we ensure, as we've been discussing, that those SMEs and the coastal communities can actually play a lead role? So I'm afraid I'm going to have to, I'll wave after 1 minute for each of you, but maybe Angelique, we can start with you, then go to Serge, and then Marcus, you can have the final word, and we'll hand over to Helen at that point.
No, I'll keep it simple, Karen, bearing in mind the interest of time. So there's lots of great ideas by the local communities. We've seen different ones from digital platforms connecting fishers to consumers. We've seen other ones where marine pollution being collected to then be converted into something else. I think the real issue there is, again, it's sitting down with these innovators and trying to see how do we get them to be able to access, to be able to be part of those bigger ideas, to be able to scale up. And this is where they may not have all the capacity that they require to do that. And sometimes it requires a collaboration and a co-designing process that enables us to grow their ideas together with them. So without that, I feel that we won't have the opportunity for growth. I'll leave it there, but more collaboration, more capacity building, I think is really part of the answer.
Underlining that capacity building piece as part of the financing and the investability. Serge.
Yeah, I'm gonna go a little bit left field here. Having worked and being, coming from Europe and having spent, the last 18 years in South Africa working with fisher communities, it's been really clear from the early onset that that fishers have immense local ecological knowledge. They have a construct of ecosystem functioning, ecosystem interactions, changes, potential effects of climate change in their heads, in their community, and that is often handed over from generation to generation. For me, when we think about sustainability and we define sustainability, we need to recognize that body of knowledge as well, and bring that kind of knowledge, that kind of epistemology to the table. Otherwise, it's going to be really, really hard to achieve any form of legitimacy for any standard.
Very strong point, well made, and to the point, Serge. Thank you, Marcus. You've actually got no time. We're going to give you a minute.
Yeah, so we have fortunately also the lending business, right? Maybe I can lend sometime from someone. So very, very quick. So what we need is we need a new enlightenment of economics, but across the entire society, including the global south. So we should not just repeat the past. We need to have a new economic thinking. Secondly, we need to increase, especially for this concept or this topic, the ocean literacy. What I do not know, I don't value. Quite simple. And at the end, thirdly, we also have to rethink our global institutions. It's not okay in the future where we have more challenges that some global NGOs just focusing on the developed countries. And we have all the institutions in place. Maybe we have to repurpose them a little bit more instead of building new institutions. So we need to redesign the entire topic of how we govern this transformation, I think. We have all ingredients. We just need to rearrange this. And last but not least, we can't do this alone. This needs cooperation. But we also need to bring the entire society with us, because it's not a company topic. It's also a topic of the poorest of this world, because they don't have to think about the day after tomorrow. They think about tomorrow. And then this is something what we haven't addressed so far in our golden cage we are living in. And this is something which worries me most, that the big part of the economy still functions as 100 years ago. And this is something what we clearly also have to change.
Well, thank you, Marcus, and thank you, everyone. This has been a really fascinating discussion. I feel like we could continue talking. We've just scratched the surface, but hopefully this is the beginning of a discussion. And as we lead into Stockholm +50 and the UN Ocean Conference, we can begin to see how these different pieces fit together. Helen, I think the simplest thing at this point is for me to just turn the floor over to you. I'm not sure, Albert, if you wanted to add anything as well, and hear your reflections, no small task, on some of the discussion we've been having this morning.
Thank you so much, Karen and Albert, for inviting me to conclude this webinar. We have listened to two extraordinary panels with excellent presentations, shedding light on the topic of today's webinar. And I will not try to summarize the rich discussion, but rather highlight some of the important messages that the presenters has conveyed. So, from the discussion today, it is quite clear that we are in a hurry to mobilize knowledge, innovative solutions to improve governance and develop regulations, as well as voluntary approaches, engage stakeholders and make the money flow towards the ocean. And my first point is that, well, with a growing population reaching some 10 billion people by mid-century, we really need a healthy ocean with abundant resources and functioning ecosystems. And we are, as Jean-Baptiste said, in the midst of a blue acceleration that generates value for the economy and people. The ocean provides tangible resources such as fish, energy, minerals, etc., just to mention a few. Areas where investments are more straightforward, even though all risks might not be accounted for. But the intangible products and services such as oxygen production or carbon sequestrations, etc., for those we might need more other investment and risk assessment models and tools to move forward. And the second point is that we not only need the ocean needs us. It needs us to get our act together to prevent disruption of physical and chemical properties of the ocean and further harm to the ecosystems and its resources. And further disruption and harm will backfire on the economy and people's well-being, with stranded assets, lower profits, deteriorating living conditions and insecurity. So with that in mind, it is quite surprising that the UN Sustainable Development Goal, goal number 14, life below water, is the most underfunded goals in Agenda 2030. And that is true both for ODA, philanthropy, and private investments. So when we look at the funding needs for SDG 14, it's estimated to some $175 billion per year. And we have only managed to mobilize some 1% on average in the past decade or so. So the challenge ahead is huge, and it's time to raise ambition substantially. It also becomes clear if we compare pledges and resource mobilization for land and ocean in various ways, taking, for example, the UN Decade for Ecosystem Restoration. Even though the ocean covers 70% of the Earth's surface, only 4 out of 50 of the founding initiatives in the decade addresses ocean. So, and also if we look at the pledges for nature made at COP26 in Glasgow, the land-based finance pledges could be counted in billions, whereas the ocean ones can be counted in millions. So we really have a lot of work to do. So the next point is then that we need an integrated approach and long-term planning to stimulate investments. Marine spatial planning is important to handle multiple use of ocean space, but we also need to have tools to assess the cumulative impact on the ocean from different activities and sectors. And open data and transparency are really key here. While we are working mostly with marine spatial planning at national level, maybe we also need to look and work harder in regional cooperation in regional sea basins, but also for the high seas. And then if you allow me to give some reflections also on things that we haven't discussed that much today, is the role of local and regional governments. So they play an important role and should be included in the discussion to a greater extent, since they have taken important decisions and shaping cities and infrastructure investments and industry establishments, education and much more of importance. And then another thing that Search raised, but we are not discussing that much either, is that we need to discuss gender when we talk about developing the blue economy. The growth we see in maritime sectors, which are very male dominated, will amplify gender inequality instead of fighting it. We have to be very cautious about female rights, resources and representation, and work actively to increase job opportunities, investments and influence of women. And then I have worked a lot with climate issues before I started to work with ocean issues. And in my experience from working with climate change, we have seen several important reports that have really spurred discussion and also changed the discourse in climate debate and action. And one such report is the Stern report about the cost of inaction, where Lord Nicholas Stern and his team estimated costs for business and societies under a business as usual scenario if we fail to mitigate climate change. Another report was the new climate economy report by the Global Commission on the Economy and Climate, where efforts were made to monetize the benefits of action. So when looking at co-benefits of climate action, such as reduced air pollution with improved health or energy security, etc., a new narrative was formed focusing less on historical debt and burden sharing and responsibilities to pay, etc., to a discussion of self-interest for action, opportunities, and improved quality of life. So these perspectives of cost of inaction and benefits of action are important and valid also when we discuss ocean health and blue economy. So, we have heard also very concrete proposals, a lot of proposals here today, and I mean, I think we both public funding and private funding and investments must go hand in hand, and the former should be used more to mobilize private investments and be designed to incentivize innovation that supports the transformational change that are needed. And international finance institutions and multilateral development banks also have a crucial role to play in supporting investments and also policy development at national level. And it's quite inspiring, I think, with new instruments that are being developed, like impact funds and blue bonds, but that certainly isn't enough. But we have to really adopt clear principles and redirect mainstream finance towards sustainability also in the maritime sectors. So it's been really fascinating to listening today to this discussion, and very good and inspiring talks by our panelists. So thank you so much.
Thank you so much, Helene. Karen, I'll jump in and just say a few final words before we end with 3 minutes left. And it's been an extremely interesting and dense discussion with so many different strands of thought and elements being discussed. And Helene, you have the monumental task of trying to summarize that, but I think you did fantastic to capture some of these paradoxes and synergies in this big cocktail of issues we're talking about here, challenges and opportunities. But I think you touched upon something towards the end, which is critical, and a lot of the panelists also mentioned, is the real need for its transformative practices at the end of the day. They need to be equitable. And it's going to be extremely interesting in light of the third and final part of the sixth assessment, the Ipcc assessment, which will be focusing on some of those transformations in its final report. But that's an issue which is growing in its importance, both within science and policy and the finance sector, the need of how to understand, mobilize, finance, and operationalize these transformations that are needed. I won't spend more time saying anything new. I just want to say a huge thank you to the panelists, first and foremost, for joining us, sticking around, and being extremely clear and well articulated under this long time. And it's always difficult under these circumstances in Zoom to carry on a conversation, but I think it was brilliant. Also, huge thanks to the attendees, everyone listening in, and to Karen for joining me and helping me navigate this conversation. I'm just going to share a final slide here, just to give you some links that could be useful, because like we mentioned before, this dialogue is part of a longer series of dialogues feeding into the Stockholm Plus 50 process. So if you want to catch a recording of this session and stay in tune with the report that captures the strands of this full dialogue, then just go into the beijer.kva.se website there. If you're interested in just these broad topics, a few good starting points are the Global Resilience Partnership websites and the Ocean Risk Alliance or a website there. And then I didn't capture all of it, but a few reports that were thrown around in the chat, a link to the different presentations. I've also given links to them there. I'll stop now. I'll leave this on for a couple more minutes before stopping my share screen. And again, a warm and big thank you to the panelists and